But in terms of where we are on the personal side, we're also now in the realm of a kicker, in part due to increases in the changes in the tax law, and in part due to other forecast changes, both indirect influences of the tax law and improved economic outlook going forward. Here you see the evolution of our personal income tax kicker base, which includes not only personal income taxes, but everything in the general fund outside of corporate taxes. And as of this forecast, you see we've also included the small impact of what was passed on Monday. It's already folded in here, but it does put us above the 2% kicker threshold. We're now at 3% higher than the close of session forecast, which would generate a kicker of $555 million that goes out then when people file their taxes in 2020 or in 2019.
So much for Senator
Mr. Chair.
Yes, Representative
I
Finley.
have a question. I'm trying to follow the numbers and I'm somewhat confused. It appears by looking at that as a result of increased revenue due to Senate Bill 1528, we brought in $245 million additional dollars. We then reached the threshold for the kicker, which we now have to spend $555 million on the kicker. So we should be ending the year at about $300 million in the hole. Am I not getting that? Am I reading that wrongly? But that doesn't look like good math.
Representative Finley, Chair Haas, this is a really, there's a lot of moving parts here, and this is a really complicated one to explain. But I will do my best. So first of all, with our recently enacted pass-through deduction piece, as you mentioned here, the Senate Bill 1528, it's not appropriate, although technically it's the case that without that tax law, there wouldn't be a kicker in the baseline right now. That's difficult to do. In general, there's always so many moving pieces to this, that we have this mistake that's plus 200, this one that's minus 200, and adding them all up, we hope that the God of offsetting errors will save us like they usually do. And so at the end, it's hard to take just one piece and isolate it. And in particular, this one is maybe not appropriate because in terms of the context of the kicker, we're comparing today's forecast to what was forecast at the close of session back when the legislature was in session in the odd number year. So, what was going on then? Well, we didn't have the federal tax bill out, and we didn't have a 20% deduction that we, as you'll see at this, when LRO talks about the connection to federal taxable income versus AGI, there's just a handful of states that had to take that 20% deduction in their own income as well, and we were one of them. But then after the Senate passed the fix, well, then that 245 went away. So you see in our graph here, it's a minus and a plus. So relative to the close of session, which sets the bar for the kicker, there has been really no change on this one dimension, right? The legislative action just put us back to where we were then. And so as much as I'd like to blame the errors on the policymakers here, this one I think we have to own because, on this one dimension of federal tax law, there hasn't been a change relative to the close of session.
Right. It certainly appears that when the smoke all clears, we're going to be $300 million in the hole.
Yeah, so the accounting is complicated, and I'm going to do my best here on the next slide to try to walk through it. But the main issue here that makes it so it's not a massive hole that you would think, okay, we're going to pull $555 million out of the revenue stream. The reason that might be misleading is because, well, why do we have that kicker? Well, because we got a lot more money today in the current biennium than we expected. And so unless we take that money out to the burn barrel in the backyard, on net, things don't look so bad. And also, maybe we got some of this money because the economic and revenue situation is better than we thought, which will carry forward, and we got a higher jump off point, and then going forward, maybe more growth than we expected before, coming from a larger base.
And so we're gonna see even a more volatility out as we get into the beginning of the next legislative session in this whole revenue scheme. It's gonna sort of be all over the place. And so, I would caution members before we start jumping up and down on what we're gonna do and how we're gonna do it, that it's going to get worse in terms of figuring out what to do into the future.
Certainly, too, Senator Boquist, always the hardest for us to forecast. Absolutely true that the capital gains related revenue is much more volatile than even the underlying stock market, right? Because what happens when you start to see a stock market correction is, well, people start to, there's a lot of volume of trades, and they start to cash in gains that they may have held for 8-10 years, on paper. And so even though the price of stocks is going down, people are cashing in this mountain of unrealized gains. And so temporarily, our tax receipts are inflated or held up, even though the market's turning down, but then the bottom drops out. And that's what happened in the last stock market cycle, when we went from $10 billion of realized capital gains to $2 billion overnight. So I think you need the broader time period to understand that this wasn't a tax increase, but just a fix and patching the revenue loss that we saw.
Well, thank you. And if I could, Mr. Chair, I think it would be useful. People look at these kinds of charts pretty simplistically. All the discussion you and I are having really, it may not matter to somebody out there looking at these charts. It would be really great if we could have a chart that showed the end of session forecast and the net changes that have occurred since then. Net meaning things that simply cancel each other out don't show up.
So if there's anyone left who isn't confused, we can fix that now with the next chart. What's going on with this evolution and in terms of available resources, which is what everybody here fundamentally cares about. So the starting point, back to Representative Finley's question, what happened to revenues in the current biennium? That's that top left-hand $810 million increase for today's revenues. How does that break down? $500 million from tax law changes directly, and then $300 million from other stuff, both the indirect tax law changes that we're working in and increase in our forecast. Increase in our forecast has two parts. One is the tracking that I mentioned before. We're getting a lot. We've had a lot in the door and are running ahead of projections. And second being a little bit more economic growth expected in the outlook. That comes largely from the fact that in last March, we didn't have the spending part of the fiscal stimulus plan. We had the tax part. We didn't have this budget bill at the federal side, and that increased growth a little bit more as well. And so 500 in direct tax law changes, 300 in other stuff gives us 800 million in revenues. We adjust.
Representative.
Oh, sorry.
Let him finish.
So we adjust that for increased expenditures during the last session and the like, add our lottery funds, and we end up with today $772 million more in revenue in this current biennium than we expected in March. So that's a pile, but then a lot of it's going to come off in the next biennium. Depending upon how much the legislature chooses to spend out of that today versus save in reserves for the next biennium, that is going to determine the size of the impact next time. So next time you see here we have a negative impact on revenues of 219. There are two things there. There's the kicker that everyone knows, the $555 million kicker is coming out. And then there's also this transfer out of the repatriation money. We think it's going to be about $145 million. So those are the two big pieces. But we do have some additional growth in there, so it's not a 100% reduction relative to March. But nevertheless, it's a significant $222 million reduction in what we expect next biennium. So you put these two together is the way I like to think about it, because we don't have a spending plan for the next biennium yet. So the story would be $550 million in increased resources for the two biennia put together, depending on when you want to use it. Both in our underlying economic forecast and in the revenue forecast, we just have this soft patch in this 2021. It's been there for a long time, and there are a lot of reasons for it, both in terms of the pullback of the federal fiscal stimulus, increasing monetary policy. We have the ramping up of our minimum wage and inventory issues and all sorts of things that would kind of point toward that period as a potential soft spot. And we have this in our forecast right now. That is something that we're really going to obsess about between now and when we meet you next time. Why? Because this is the traditional mistake that our office makes. As we're getting at the very end of a cycle, we start to say, oh, well, things are slowing down and we got a weekend, but then we'll have a couple of darn good years just before the bottom drops out. And that's when we give out these, big kicker payments, is when we'll get this, big year just at the end when things are about to turn down. Then we finally talk ourselves into cranking up the forecast, and that's when the bottom drops out and we miss on both sides. And so that's really what we're obsessing over now. It's very hard to time the downturn, but it does appear that's if we continue to see growth, I think that would increase our outlook. Now we have a couple of relatively soft biennia expected in the forecast. Before it was 17-19. This is the direct impact of the new kicker on growth in 1921 as well. Now is going to be less than 10% over the biennium, but that would be a normal sort of year. You wouldn't see the sort of slow down in growth rates and then the speed up. If not for that kicker, it would be a much more stable underlying outlook that's being paid out of there. So finally, last comment is that it's really not just about the revenue in the general fund that we talk about. We're worried, piggybacking off of Representative Smith's comments, and this, we have to worry about the fact that we're in a pre-crisis period right now, which I completely agree with. But some encouraging things are happening outside of our backyard, which is the general fund. The biggest being, I always talk about these reserves, that Oregon now has reserves, which it's never had before, because we have automatic deposits into the Education Stability Fund and the Rainy Day Fund. But also importantly are some of the cost containment efforts that this body's been putting together that are starting to bear fruit. Senate Bill 1067 is significant, and as we've mentioned earlier today, we're talking about to what extent, like in Senate Bill 1529, to what extent can we take one-time revenues or whatever and try to apply them to some of these unfunded liabilities of the state. And so I think, we're in a much better place in terms of the more broad financial management of the state than we have been going into previous recessions. And I think a lot of that has to do not just on the revenue side, where sometimes reform can be very, very difficult and an uphill battle, but on the management side, both in terms of these cost containment efforts like 1067 and the squirreling away of reserves for the rainy day.
And to have had reserves like this in the two recessions we went
Absolutely.
through, 01, 02, and 08. This is a game changer for Oregon's tax code. This is just really phenomenal. This is what everybody wanted. And, very healthy.